Good morning and welcome to the Killik market update. It's been a fairly tough couple of weeks for markets and investors have really been on the lookout for good news. So there's been a lot of focus on the current earnings season. This week has been quite a big one for technology stocks and we've had three of the largest companies on the stock exchange reporting this week: Microsoft, Amazon and Alphabet. Now, the last few years have been very strong for technology stocks, and they've really risen quite heavily because their underlying profit growth has been so strong. And that profit growth needs to remain strong to justify the high valuations that some of these companies are trading on. So let's have a look at some of the key takeaways from these results. Microsoft reported on Wednesday after hours, and their results were fairly far ahead of expectations. The key number here was the growth in earnings per share. That's a key measure of profit growth. That was up 36%. And something else positive was that it was fairly consistent across all areas of the business. Microsoft saw strong results in Office, Windows and also cloud computing. So we did see quite a significant rise in Microsoft shares after these results came out. Amazon and Alphabet, on the other hand, both reported last night after hours, and their results were both a little bit below expectations. And the disappointing thing here was the numbers for sales or revenue. Now, Amazon guided towards sales growth or revenue growth of 10 to 20% for the holiday season this year, and that was a little bit below investor expectations. Now, the stock was down 9% in after-hours trading yesterday, but it is important to bear in mind that the day before, a lot of people bought in before the results came out, and the stock was then up 7%. So with that in mind, that 9% fall doesn't look quite so severe. Now, for Alphabet, the key figure there was the growth in advertising of 21%. Again, that was slightly below expectations, so the stock was down a little bit in after-hours trading. But on the positive side, even though for both of these companies the sales or revenue growth was slightly below expectations, profits were actually above expectations for both companies, and that suggests that costs were also below expectations. And that's a positive because there has been some concern that these companies will have to spend more on things like cybersecurity and keeping up with regulations. So to have profits above expectations and costs below, definitely a good thing for both of those companies. Another key takeaway from the current earnings season is the amount that traditional banks are spending on technology. Now, we hear quite a lot about how these banks are always closing down their branches, but we don't hear so much about just how much these banks are ploughing into digital and technology. Now, Citigroup now counts technology as 20% of its total expenses bill, and this year the bank has even set up its own online digital bank. JP Morgan is spending $10 billion on technology this year, and it now employs 50,000 people in its technology division. Now, new challenger banks over the last couple of years, such as Revolut and Monzo, they've really raised the bar in terms of how much consumers expect from their online banking experiences. So we're really seeing more traditional banks raising their own bar in order to compete. So the amount of investment here we're seeing is huge. And quite a good way of putting it across is a quote from Mark Benioff, who's the chief executive of Salesforce, which is a cloud computing company. Citigroup has actually spent quite a lot with Salesforce over the last couple of years. And recently, Mark Benioff was quoted as saying he's never seen such a robust spending environment, and probably the number one these chief executives are spending money on is their own digital transformation. So I think that's quite an important thing to take note of. And last of all, monetary policy in the US and the eurozone. There's been quite a lot of commentary recently about how these monetary policies are diverging. The US for quite some time now has been raising interest rates, tightening monetary policy, ending quantitative easing, making it more expensive to borrow money. The eurozone, on the other hand, is still carrying out quantitative easing. It's still buying bonds to push up those bond prices and bring down the yields, making it cheaper to borrow money, and it's still got a negative deposit rate of interest of minus 0.4%. The European Central Bank had said it would end quantitative easing in December, but since then the European stock markets have been fairly weak, as you can see by this chart here. And there was perhaps a bit of speculation that the European Central Bank would extend the support that it's currently giving to markets. However, this week there was a European Central Bank meeting. The bank has kept interest rates on hold, but it has said it will definitely be ending quantitative easing in December. So that really does show now that monetary policy in the Eurozone and the US is starting to converge a bit and that we are starting to move in the same direction. Now, moving on to the week ahead, again, it's still earnings season, lots of companies reporting. Next week is a fairly big one for UK banks and for UK oil. So we've got results coming out from HSBC, Standard Chartered, Royal Dutch Shell and BP. That's it from us. Have a great weekend and we'll see you next Friday.